Welcome to Capital Allocation Lab.
Subscribe and like to support more educational episodes.
So, let's just get right into our topic for today.
Yeah.
We are looking at, what is arguably the single biggest outlier in the market today.
Yeah, without a doubt.
And we're basing this purely on the company's latest financial reports. No rumors, no hype, just the numbers.
Exactly. And to be super clear from the start, our mission today is very specific. We are conducting a strict Graham-style margin of safety analysis.
Right. We have the income statement, the balance sheet, the cash flow statement, and the non-GAAP reconciliations right in front of us. And we are basically going to tear them apart.
We really are, because if you were listening to this, you likely already know the narrative surrounding this company. I mean, the sheer scale of the numbers is just breathtaking.
It really is.
But we are here to look past that narrative, right? We want to focus purely on the structural reality of the math.
And that framing is it's just critical for you, the listener, to keep in mind as we go through this. We're not sitting here asking, is this a great business?
No, not at all.
Because the financials we're about to unpack clearly show that it is. It's undeniably an extraordinary business.
Yeah, the underlying economics are historic. But the harder question, and really the question that actually determines your risk as an investor, is what can go wrong?
Right.
And how much of that risk is already reflected in the share price?
That is the core tension right there.
Yeah.
It is not the business itself. It's the terrifying math of the price tag.
Terrifying is a good word for it.
Because, the balance sheet is golden, the margins are exceptional, and the free cash flow is massive. But the valuation is so incredibly high that the business has to stay absolutely exceptional.
Like essentially perfect.
Exactly. Just for the current price to make sense.
Yeah.
We're dealing with an asset where the fundamental tension is completely decoupled from business quality.
Yeah, it is entirely about expectation. So we are going to build what we are calling the Outlier scoreboard.
I like that, the Outlier scoreboard.
We really need to look closely at what investors are actually paying for earnings and for assets. Because to truly understand the margin of safety or, the complete lack of it, we have to start with the foundational math.
So let's start with the price to earnings ratio, the PE.
Right. And to build that scoreboard, we just use the raw inputs from the latest financial reports. The formula for PE is pretty straightforward. You take the share price and divide it by the diluted earnings per share.
Okay, so currently the stock sits at $220, and the company has 24.3 billion shares outstanding.
That is a lot of shares.
It is. So when you multiply those together, it implies a market value of about $5.346 trillion.
Which is just a massive denominator. And now, if we look at the fiscal 2026 GAAP earnings per share, that comes in at $4.90.
So $5.346 trillion against an EPS of 4.90 cents.
Right. And that price gives us a multiple of roughly 44.9 times earnings.
I really think we need to stop and just chew on that number for a second, because in a modern market, people throw around high multiples so casually.
We really do. We just get numb to them.
Exactly. We get numb to it. 44.9 times earnings. But we are applying a strict Benjamin Graham defensive lens today.
And under that classic defensive framework, Graham's threshold for a defensive investor is 15 times earnings. That is the ceiling.
The absolute maximum.
Right. If you want a margin of safety, you just do not pay more than 15 times what the business earns in a year.
So right out of the gate, we are looking at a 44.9 times multiple compared to a strict ceiling of 15 times.
It shatters the ceiling entirely. I mean, it's not even close. And to make the gap between those two numbers visceral for you, let us reverse the math.
I like this. Let's do it.
If you wanted to fit this company into a defensive 15 times framework, right, while keeping the stock price at exactly $220, the earnings per share would need to be about $14.67.
Hold on, let me process that. The actual fiscal 2026 GAAP EPS was $4.90.
Yeah.
And you were saying that to justify a $220 price tag safely, under Graham's rules, they would need an EPS of $14.67.
That is the math.
That is roughly 3 times their current bottom line output.
3 times the output, yes. And the vital context here is that we are not talking about a startup tripling its earnings from, a base of $10 million.
Right, which happens all the time.
Exactly. We are talking about a company tripling an earnings base that is already historically massive. The gap between the $4.90 they are actually earning and the $14.67 they would need to earn to be a safe value at this price, that is pure, unadulterated valuation risk.
Because it represents the premium investors are paying for future growth that simply has not materialized yet.
Exactly.
Okay, so that covers the earnings side of our scoreboard. Let us pivot and look at the balance sheet.
Yeah, the asset side.
Right. The second metric on the Outlier scoreboard is the price-to-book ratio, the PB. And the calculation there is the market value divided by the shareholders' equity.
And as we just established, the market value is a staggering $5.346 trillion.
Correct. And according to the balance sheet, the fiscal year-end shareholders' equity was $157.293 billion.
Okay, so if you divide that $5.346 trillion market value by the $157.293 billion in equity, what do you get?
You get a multiple of about 34.0 times book.
Wow, 34.0 times. But, from a strict margin of safety perspective, we can't really stop at basic book value.
No, we can't, because a defensive investor wants to know what happens if everything goes horribly wrong.
Right. You cannot liquidate brand recognition or intellectual property easily in a fire sale. Nobody is buying your Goodwill to pay off your debts.
Exactly. So we have to look at tangible assets. And when we subtract goodwill and intangible assets from that shareholders' equity, the tangible book value drops.
How much does it drop by?
It drops to about $133.155 billion.
Okay, so when you divide the $5.346 trillion market value by that $133.155 billion tangible book, the price-to-tangible book ratio skyrockets to about 40.1 times.
40.1 times tangible book. I need to interject with an analogy here, because 40.1 times tangible book is a really difficult concept to grasp just as a raw number.
Yeah, it starts to just sound like abstract math. Give me the analogy.
Okay. Imagine you are looking to buy a highly specialized elite business. Let's call it a championship-winning Formula One racing team.
Okay, I'm picturing it.
If you buy the tangible book value, you are buying the metal, the carbon fiber, the tires, the tools, the actual garage itself.
The physical stuff you can touch.
Right. You tally all of that up, and someone is asking you to pay 40.1 times the value of those physical assets to buy the team. You aren't paying for the metal anymore.
No, you're paying for the legacy, the future win.
Exactly. You are paying an astronomical premium for the assumption that this car is going to win every single race without fail for the next decade.
And if it doesn't?
If it finishes in second place even once, the value you paid completely collapses, because the underlying physical assets and the tires and the tools they offer you, absolutely no protection at that price.
That's a great point.
You have to ask yourself, as an investor looking at a 40.1 times multiple, does the traditional asset cushion even exist here?
I mean, the Formula One analogy captures the mechanics perfectly. You are entirely exposed to performance risk because the asset cushion is effectively zero. For a defensive investor, an asset cushion is your downside protection. If the earnings power of a business falters, the physical liquidatable assets provide a structural floor of value.
Right. And Graham's traditional rigid test for price to book is a ceiling of 1.5 times.
1.5 times. So compare a 1.5 times ceiling to the 34 low times book and the 40.1 times tangible book we are looking at.
It's just laughable.
It is. And it actually gets more extreme when you combine the metrics.
Oh, right. Let's do that combined math.
So Graham formulated a combined test to ensure you weren't overpaying on both earnings and assets simultaneously. You multiply the PE by the PB.
Makes sense.
Graham's classic combined ceiling is 22.5. So if we take our PE of roughly 44.9 and multiply it by our basic PB of about 34.0, the combined multiple is around 1,526.
1,526 compared to a ceiling of 22.5. That is not just overshooting the target, that is launching into a completely different stratosphere.
It really is. And what a combined multiple of 1,526 tells you mathematically is that the stock price is completely fundamentally decoupled from the underlying asset base.
You are buying pure earnings power.
Pure earnings power and pure future growth expectations. If the growth story slows, there's just no floor beneath you.
So this brings us to a really fascinating question. If the asset cushion is that thin, if it practically does not exist, does the sheer raw volume of cash the company generates justify the valuation?
That is the trillion-dollar question.
Literally. Let's move to the third item on our scoreboard, the cash yield paradox. Let me read you the free cash flow figure from the latest financial reports.
Hit me with it.
The free cash flow was $96.575 billion.
Unbelievable.
Let that sink in. Nearly $100 billion in pure free cash flow.
It is a staggering achievement. I mean, very few enterprises in the history of capitalism have ever generated $96.575 billion in free cash in a single year.
No, it's almost unprecedented.
But as an investor, you cannot just look at the absolute cash generated. You have to look at your yield. You have to measure what you are getting relative to what you are paying. To calculate the free cash flow yield, we divide that $96.575 billion by the $5.346 trillion market value.
And when you do that math, the yield comes out to about 1.81%.
1.81%.
And this is the paradox. I look at this and I am genuinely confused by the market psychology. How does a business print $96.575 billion in cash, a number that defies comprehension? And yet, if you buy the entire company today, your cash yield is only 1.81%.
It's totally counterintuitive.
You could put your money in a remarkably safe, boring government bond and get a significantly higher yield than that. How does this math make sense to anyone buying at $220?
Well, it only makes sense if you assume today's numbers are just the very beginning. That is the central tension of the valuation right there.
A beginning.
Wow. The numerator in our equation, the $96.575 billion, is historically massive. It is an operational marvel. But the market value denominator, that $5.346 trillion, is so incomprehensibly large that it violently dilutes the cash flow into a meager 1.81% yield.
So if you are the investor, right, what does this 1.81% yield actually mean for your portfolio?
It means that the current cash being generated, despite being nearly $100 billion, is mathematically insufficient to provide you with a satisfactory return on your capital.
It's just not enough.
No, it's not. Therefore, future growth has to do all the heavy lifting in your valuation model. The market is pricing in the absolute certainty that the $96.575 billion is merely a stepping stone.
It must grow substantially.
Exactly. And it must sustain that growth for years simply to justify the $220 entry price. If free cash flow stays flat at $96.575 billion forever, you are stuck with a 1.81% yield forever, which is a terrible investment.
Right. The current cash isn't the reward. It's just the ante to stay in the game.
That's a great way to put it.
That incredibly low yield implies the market is betting heavily on sustained, extraordinary performance, which naturally transitions us to the fourth part of our scoreboard, the margins.
Yes, the margins.
Because the market is betting on perfection, so let us look at how perfect the economics actually are. I have the exact income statement margins right here.
Let's hear them.
For fiscal 2026, the GAAP gross margin was 71.1%.
71.1%.
Wow. Yeah. The operating margin was about 60.4%. The net margin was about 55.6%. And the free cash flow margin was about 44.7%.
We really have to pause and put those numbers into historical context. These are not just good margins, these are supernormal business economics.
Supernormal.
Generating a 71.1% gross margin and keeping 60.4% at the operating line, especially across a massive revenue base, is a phenomenally rare outcome in financial history.
Rare is an understatement.
Right. It implies immense pricing power and an almost total lack of competitive pressure at the moment.
But I have to push back a little on the durability of this. You say it implies a lack of competitive pressure. But capitalism, by its very nature, attacks 71.1% gross margin.
Oh, absolutely. It's like blood in the water.
Exactly. When a company is keeping 71 cents of gross profit on every single dollar of revenue, every competitor in the world looks at that and wants a piece of it.
They want to commoditize it.
Right. So how often in business history do margins like 71.1% gross and 60.4% operating stay completely unchallenged?
Extremely rarely. And that is exactly the point a defensive investor must consider. The risk here is not that these numbers are bad.
No, the numbers are incredible.
They are. The risk is the extreme fragility of the assumption that they will never, ever compress.
Right.
A valuation can certainly be built on peak margins, but a margin of safety investor has to ask, what happens when gravity takes hold?
Because gravity always takes hold.
Exactly. What happens if a competitor enters this space? What happens if pricing power wanes even slightly? What if capital expenditures have to rise to maintain a technological lead?
If any of those things happen, the margins get squeezed.
Precisely. They revert to the mean. And a valuation resting on a $5.346 trillion market cap is uniquely vulnerable to mean reversion.
Because there's so much air underneath it.
Yes. Any contraction in that 60.4% operating margin disproportionately impacts the bottom line. And because the multiple is 44.9 times earnings, every lost dollar of earnings destroys $45 of market value.
That is terrifying math.
It is priced for perfection, which makes it highly fragile.
And the returns confirm that supernormal status. Let us look at the fifth part of our scoreboard.
Okay, let's look at returns.
Using the balance sheet and the income statement, the return on equity was about 101.5%. The The return on assets was about 75.4%. And an approximate cash-adjusted return on invested capital, or ROIC, was about 149.8%.
Just wow. To translate those metrics for you, a return on equity of about 101.5% means the business generated more in net income in a single year than its entire equity base.
It doubled its equity in a year.
Basically, yes.
Right.
And an approximate cash-adjusted ROIC of about 149.8% represents staggering, almost unheard of capital efficiency. They are extracting massive value from every single dollar deployed.
But again, in the stock price, the $220 already assumes these supernormal returns remain supernormal indefinitely.
Yes, you are paying for the 149.8% ROIC to be permanent.
Okay, so we have thoroughly explored the valuation risk. The multiples are dangerously high, the cash yield is paradoxically low, and the margins and returns are at historical, vulnerable peaks.
It's a precarious setup.
It is. But let us look for traditional financial distress, because we need to ask, are there any cracks in the foundation itself? Let us move to the sixth metric: liquidity and the balance sheet.
Let's get into the structure.
I will read the liquidity ratios. The current ratio, which is current assets divided by current liabilities, was about 3.91 times. The quick ratio, which uses cash, marketable securities, and receivables divided by current liabilities, was about 3.14 times.
So from a purely structural standpoint, this easily passes Graham's defensive checklist for financial strength. There is absolutely no classic overleverage or liquidity stress here.
None at all.
The company has immense short-term flexibility.
And the absolute numbers are almost aggressively safe. Cash and marketable securities were $62.556 billion against total debt of only about $8.468 billion. Net current assets were about $93.442 billion.
It is a golden foundation.
Open?
When your cash and marketable securities of $62.556 billion dwarf your total debt of about $8.468 billion, you just do not have to worry about credit markets seizing up or interest rates bankrupting the company. They're entirely self-funding.
Okay, so the balance sheet is pristine. But let us pivot to the other side of the risk ledger, which brings us to the seventh part of our scoreboard: concentration.
This is huge.
And this is where the story gets incredibly precarious. According to the financials, full-year data center revenue was $193.7 billion. Total fiscal 2026 revenue was $215.938 billion.
So you do the math on that.
If you do the math, that means data center was about 89.7% of total revenue.
That is a massive structural consideration. A single revenue stream making up almost 90% of a $215.938 billion top line is a giant concentration risk.
It's all your eggs in one very expensive basket.
Exactly. You have to understand that this one segment is the engine of the entire growth story. It is the sole reason they generated $96.575 billion in free cash flow.
Right.
But because it is so dominant, it is also the central fragility point of the entire business.
It is the ultimate double-edged sword. If you're listening to this and trying to gauge the risk, think about the pressure on that one pipeline.
The pressure is immense.
If data center demand falters even slightly, there is no secondary business line large enough to catch the fall.
No safety net.
Exactly. You do not have a robust consumer division or a massive enterprise software division to smooth out the earnings. You have $193.7 billion resting almost entirely on one specific market segment's demand.
And the margin risk is tied directly to that concentration. When 89.7% of your revenue comes from one segment, your 71.1% gross margin and your 60.4% operating margin are entirely dependent on maintaining absolute pricing power within that one specific segment.
Because if you lose pricing power there, you lose it everywhere.
Yes. If clients in the data center space decide to delay upgrades, or if a competitor offers a cheaper alternative that forces a price war, the disruption does not just hit a division, it hits the entire enterprise.
The whole financial edifice shakes.
It absolutely shakes.
So taking all of this in, the high concentration, the flawless balance sheet, the supernormal margins, the astronomical multiples, what is the absolute floor of value?
That's what Graham would ask.
Right. And practically speaking, what must happen for the $220 price to be justified moving forward? Let us walk through the Graham number calculation to find that theoretical floor.
Okay, let's run the formula.
The Graham number formula uses EPS of $4.90 and a book value per share of about $6.47.
Let us unpack the mechanics of that formula so you understand why it matters. The Graham number is calculated by taking the square root of 22.5 times the EPS times the book value per share.
And the goal of this formula?
The goal of this formula is to provide an old-school, rigid anchor based on verifiable assets and current earnings. It is not designed to be a growth stock price target.
Oh, definitely not.
No, it is designed to tell you what the business is worth if growth starts tomorrow. And here, using the $4.90 EPS and the $6.47 book value per share, it lands at roughly $26.71.
Wait, $26.71? I have to be honest, if I went on a financial network tomorrow and claimed this stock was only worth $26.71, I would be laughed out of the room.
Well, you'd be ridiculous.
Because the stock is at $220. Why should a modern investor looking at $96.575 billion in free cash flow care about a Depression-era formula that spits out a $26 valuation? Does this actually prove the business is only worth $26.71?
No, it absolutely does not prove the business is only worth $26.71. And you are right, the market would ignore that number because the market is pricing in the future.
Right.
But from a margin of safety perspective, you must care about that number because of what it signifies. It proves that at $220, the stock has completely abandoned its old-school asset and earnings safety net.
And that is gone.
It's gone. The gap between $26.71 and $220 is pure speculation on future performance. You are operating entirely in the realm of predictive confidence.
That makes sense. It isn't a price target. It is a measurement of a safety net, and the measurement says the net does not exist.
Precisely.
We discussed earlier that the Formula One car has to win every race. To justify $220, we can outline 5 specific things that must remain true. Perfection is essentially required across 5 dimensions.
Let's walk through them. First, margins need to stay near these extraordinary levels. The gross margin around 71.1% and the operating margin around 60.4% simply cannot collapse.
Second, exceptional free cash flow conversion must continue. We noted the fiscal 2026 free cash flow margin was about 44.7%. That is the free cash flow divided by total revenue.
That incredible conversion rate has to hold steady, because if costs rise and that conversion drops, the cash yield shrinks even further.
Right. Third, data center demand has to remain incredibly strong. As we saw, it represented about 89.7% of total revenue in the latest fiscal year. It is the solitary pillar supporting the entire revenue structure.
Any crack in data center demand is catastrophic.
Fourth, regulatory shocks cannot take a large bite out of revenue or margins. The global regulatory environment must remain cooperative or at the very least stable, allowing them to ship their high-margin products without severe restriction.
And fifth, capital allocation has to remain rigorously disciplined. The company returned massive amounts of capital to shareholders, but as we will see when we look at buybacks, doing so at a high multiple requires massive future cash flows to justify the outlay.
So if we summarize the Graham danger signs based on our scoreboard, Graham would actually love the balance sheet.
Oh, he would praise it. The current ratio of 3.91 times is excellent. Long-term debt of about $7.469 billion versus net current assets of about $93.442 billion is phenomenally secure. That part of the test passes with flying colors.
Yes, the financial strength is undeniable. But Graham would fiercely reject the valuation.
Fiercely.
A PE of 44.9 times brutally fails the 15 times defensive test. A PB of 34.0 time entirely fails the 1.5 times test.
And the combined PE times PB of around 1,526 compared to Graham's 22.5 ceiling shows that the margin of safety is completely absent.
The defensive investor checklist fails comprehensively because the price is simply too high relative to current demonstrable earnings and book value.
And even if you loosen the rules and apply the enterprising investor checklist, it still struggles. The liquidity and debt are fine, but the price versus earnings power, the price versus tangible assets, and the meager 1.81% free cash flow yield do not look conservative under any traditional framework.
So if perfection is required across those 5 dimensions we outlined, we need to apply a forensic accounting lens to the cash flow statement.
We have to dig deeper.
We need to look under the hood to see if any subtle working capital drags are emerging that might threaten that perfection. Let's peel back the working capital. Here are the top line numbers.
Okay, let's hear the raw numbers.
Fiscal 2026 net income was $120.067 billion. Operating cash flow was $102.718 billion. And free cash flow was $96.575 billion.
Looking at those figures, the first thing we test is the cash conversion. Free cash flow divided by net income was about 80.4%.
80.4%.
Converting over 80% of your net income into pure free cash flow is still very strong. But notice the gap. It reminds us that net income is just an accounting figure. Free cash flow is the actual cash left over.
Right, accounting profits versus cold hard cash.
Exactly. The gap between the $120.067 billion in net income and the $102.719 billion in operating cash flow tells a very specific story about working capital and how cash is flowing through the business day to day.
Right, the cash flow statement explicitly shows us the drags. Accounts receivable reduced operating cash flow by $15.399 billion. Inventories reduced it by $11.324 billion.
Those are significant drags.
Now, if you are listening to this and you are not deep into accounting, I want to explore how this works mechanically. How does an account receivable create a $15.399 billion drag on cash?
Let us translate the accounting into a real-world transaction. Imagine you manufacture highly specialized hardware. A massive tech client places an order, you manufacture the goods, and you ship them.
Okay, so the goods are out the door.
The moment you deliver those goods, accounting rules dictate that you record the revenue on your income statement. That revenue eventually filters down and makes your net income look fantastic. You just recorded a massive profit on paper.
But I haven't been paid yet.
Exactly. The client has 30, 60, or maybe 90 days to actually wire the funds to your bank account. Until that cash arrives, it sits on your balance sheet as an account receivable, money owed to you.
So your net income of $120.067 billion looks huge, but $15.3999 billion of that profit hasn't actually hit your bank account yet. It is tied up in IOUs.
That's perfectly stated. In a period of explosive growth, rising accounts receivable is normal because sales are accelerating so fast. But it acts as a drag on your actual operating cash flow in the present moment.
That makes perfect sense. The cash is essentially delayed.
Yeah.
But let us look at the other drag, which I think is far more concerning from a risk perspective.
The inventory drag?
Yes, the inventory drag was $11.324 billion. And looking at the balance sheet, inventory more than doubled over the fiscal year, going from $10.080 billion to $21.403 billion.
That is a massive jump.
Let's deeply analyze this inventory double. What are the operational implications of sitting on $21.403 billion in inventory?
This requires very careful monitoring. As with receivables, in a hypergrowth phase, doubling inventory can be completely normal. You are ramping up production, building up raw components, and stockpiling finished goods to meet an exploding order book.
Because you need inventory to generate the massive $215.938 billion in revenue.
Exactly. You can't sell what you don't have. However, if demand slows down even marginally, that $21.403 billion morphs from a necessary asset into a massive, looming risk.
Because in technology, inventory doesn't age well like fine wine. It rots.
Precisely. If that 89.7% concentration in data center revenue falters, you are suddenly left holding $21.403 billion in specialized hardware.
And what happens then?
In the tech sector, next-generation products are always on the horizon. If your current inventory becomes obsolete before you can sell it, you are forced to write it down.
Just take the loss.
A massive inventory write-down would directly and violently impact those pristine 71.1% gross margins we discussed earlier. It is a critical working capital metric to watch because it is highly sensitive to demand shocks.
Aside from working capital, there is also an earnings quality item we need to highlight from the cash flow statement. Gains from non-marketable and publicly held equity securities were reconciled out of operating cash flow by the amount of $8.918 billion.
This is a fascinating line item that often gets overlooked. If you look at the balance sheet, non-marketable equity securities rose to $22.251 billion.
That's a huge number for investments.
It is. Now, having $22.251 billion in investments is not inherently bad, but it is what we consider a quiet risk.
Why is it a quiet risk?
Because these are non-marketable securities. They are investments in private or thinly traded entities. The value of these investments can move based on internal marks or private funding rounds, and they do not equate to actual operating cash generated by selling core products.
Ah, I see.
The fact that $8.918 billion in gains had to be reconciled out of operating cash flow tells you that a decent portion of that massive $120.067 billion net income was actually driven by investment gains on paper, not purely by the core operations of the business.
It artificially inflates the net income relative to the cash generated by operations.
Exactly.
So we have working capital drags and some earnings quality nuances. Let us move to the seventh segment of our analysis. Capital allocation and disclosure gaps.
Where's the money going?
Right. How is the company utilizing its massive pile of cash, and what blind spots exist in the financial reports provided to us? Looking at shareholder returns, fiscal 2026 share repurchases were $40.086 billion, and dividends were $0.974 billion.
Okay, so together this represents about 42.5% of the free cash flow returned to shareholders.
On the surface, returning 42.5% of free cash flow to shareholders sounds remarkably responsible.
It does. It demonstrates that management is shareholder-friendly, and given the $96.575 billion in free cash flow, it is completely affordable. But, as defensive investors, we have to evaluate buybacks through a strict valuation lens.
Valuation matters.
Always. The risk here isn't affordability today. The risk is whether executing massive buybacks creates long-term intrinsic value for the remaining shareholders.
This is a crucial point that many people miss. A buyback is fundamentally an investment.
It is the company investing in itself.
Right. If you are the company and you repurchase $40.086 billion of your own stock at the current price of $220 a share, you are inherently declaring to the market that $220 is an attractive, value-creating price. You are buying your own earnings at a 44.9 multiple.
Yes. And if the intrinsic value of the business is actually lower than $220 if multiple compression occurs or growth slows, then that capital allocation was a poor investment.
It destroys value.
Buying back overpriced stock actually destroys shareholder value, whereas paying that cash out as a special dividend would allow the investor to allocate it elsewhere. You need massive, sustained future cash flows to justify buying back your own stock at 44.9 times earnings.
Alongside the buybacks, we must look at the cost of retaining talent. Specifically, stock-based compensation, or SBC.
SBC is a big one in tech.
Fiscal 2026 SBC was $6.386 billion. And there's an important note in the reports. Beginning in the next fiscal year's first quarter, stock-based compensation will be included in non-GAAP financial measures.
That inclusion is a significant accounting shift.
How so?
By moving SBC into non-GAAP measures, it will fundamentally change how those adjusted profitability metrics look moving forward, likely making them look less robust. Because SBC is a real cost to shareholders via dilution, even if it isn't an immediate cash outflow.
Let's check the balance sheet again for other capital allocation outcomes. Through acquisitions, Goodwill rose to $20.832 billion, and intangible assets rose to $3.306 billion.
Rising intangibles naturally elevate the importance of monitoring for impairment. Goodwill, which now sits at $20.832 billion, represents the premium the company paid over the fair value of the net assets when they acquired other businesses.
It's the premium for optimism.
It is essentially the price of optimism during an acquisition. If those acquired entities underperform expectations, accounting rules require that goodwill to be impaired.
And an impairment charge would take a direct hit to the income statement, further threatening net income.
Exactly.
And finally, in this segment, we have to talk about what the financials do not show, the disclosure gaps. As analysts, we can only grade what we can see.
And there are some glaring blind spots here.
The provided financial reports do not give enough detailed visibility on several key fronts: customer concentration, supplier concentration, segment margins, debt covenant terms, full maturity walls, or off-balance sheet commitments.
To be clear for the listener, pointing out these disclosure gaps does not mean we suspect hidden disasters or malicious accounting.
No, not at all.
It simply means these are unmeasurable risks based on the sources provided. For example, when you have a massive customer concentration risk, remember, data center is 89.7% of the total revenue. Not knowing the specific customer concentration within that single segment is a profound blind spot.
Are three massive tech companies responsible for 50% of that data center revenue? We don't know.
We just don't know. Similarly, without detailed segment margins, we cannot easily parse exactly where that 60.4% operating margin is most vulnerable. We just have to accept it as a blended figure.
Okay, we have covered the fundamentals, the drags, and the blind spots. Let us move to the 8th segment and attempt to quantify the downside risk.
The fun part or the scary part, depending on how you look at it.
If the business stays great, let's assume they continue to execute perfectly, but the market simply stops pricing it for perfection, what does the math look like? We are going to do a multiple compression thought experiment. Let us walk through PE compression scenarios based on the fiscal 2026 EPS of $4.90.
This thought experiment is vital for understanding what valuation risk actually feels like in a portfolio.
I have the scenarios mapped out. If the stock traded at 35 times the fiscal 2026 EPS of $4.90, the value would be $171.50 per share.
Okay, that's a drop.
If the market decided it should trade at 25 times EPS, the value would drop to $122.50 per share. And if we apply Graham's strict 15 times EPS ceiling, the value collapses to $73.50 per share.
Let those numbers settle because the impact is severe. Keep in mind, a multiple of 35 times earnings is still considered a premium multiple for almost any mature business in the world.
35 is very high.
Yet a drop from the current 44.9 multiple to a 35 multiple takes the price down from $220 to $171.50. A drop to 25 times earnings, which many would argue is a reasonable multiple for a dominant tech company, takes the price all the way down to $122.50, effectively cutting the market cap nearly in half. And a drop to Graham's defensive threshold of 15 times takes it down to $73.50. This happens without the underlying business breaking. It happens purely through the market changing its mind about the premium it is willing to pay.
Now let us look at it from the cash flow perspective. Let's walk through the free cash flow yield scenarios. First, we need the free cash flow per share. We calculate that by taking the $96.575 billion in free cash flow and dividing it by the 24.3 billion shares outstanding. That gives us $3.97 free cash flow per share.
Let's run the yield scenarios on that $3.97.
Okay. If the market demands a 2% free cash flow yield, that $3.97 supports a price of about $198.72 per share.
Still lower than the current price.
Yes. If the market demands a 3% yield, it supports about $132.48 per share. And if investors demand a 5% yield, which is historically quite normal for value investors, it only supports a price of about $79.49 per share.
Recall that the current price of $220 implies a free cash flow yield of about 1.81%. That 1.81% is the market explicitly saying this massive $96.575 billion cash flow base is not enough by itself to justify the price.
It's just not enough.
Future growth, sustained dominance, and extreme durability must do a tremendous amount of the valuation work.
So the ultimate question is the valuation risk truly priced into the stock at $220?
From a strict Graham perspective, the answer is definitively no. The balance sheet risk is priced comfortably. As we saw, the debt is remarkably low and the liquidity is high.
Yeah.
The business quality is visibly extraordinary, proven by those supernormal margins and extreme returns on equity. But the valuation risk, the specific risk of multiple compression, is not obviously priced in at all.
It's completely ignored.
If the broader market suddenly demands a 3% yield instead of a 1.81% yield due to macroeconomic shifts or rising interest rates, the price drops to about $132.48. And let me reiterate, that price drop happens even if the business performance remains perfectly static.
That is the textbook definition of multiple compression risk.
Yeah.
The downside comes not from the business failing, not from the margins collapsing, but simply from the multiple shrinking.
Here, multiple compression.
So for the investor observing this setup, what are the specific indicators to track to see if the thesis is strengthening or weakening over the next few quarters? We have put together a practical watch list of 10 critical items.
Let's go through them. Number 1 on the watch list, data center revenue.
The big one.
This is the absolute dominant line item, making up 89.7% of total revenue. You must monitor this closely. If this revenue stream slows materially, the entire growth model and the 44.9 PE multiple change instantly.
Number 2, gross margin. The latest fiscal year showed a staggering 71.1% gross margin, but earlier financial reports noted an H20 charge which proved exactly how quickly margins can take a hit when circumstances change.
You have to watch for any signs of compression, competitive pricing pressure, or increased manufacturing costs.
Number 3, operating expenses.
You must watch operating expenses to ensure the 60.4% operating margin does not compress. If research and development or marketing costs rise faster than top-line revenue, that operating margin will shrink, which directly threatens the $4.90 EPS that is holding up the valuation.
Number 4, operating cash flow versus net income. As we discussed, this is a vital proxy for cash conversion deterioration. The current ratio of free cash flow to net income is about 80.4%.
If that ratio drops, it means earnings are rising on paper, but the cash isn't hitting the bank, making the valuation much harder to defend.
Number 5, inventory.
You are watching to see if that $21.403 billion inventory figure keeps rising faster than revenue. It more than doubled year over year. If that pace outstrips actual sales growth, it strongly signals a structural problem and elevates the risk of massive obsolescence write-downs.
Number 6, accounts receivable. Receivables rose significantly, creating a $15.399 billion drag on operating cash flow. You need to verify that collections matter. As accounts receivable rises, you want to see the cash actually materialize in subsequent quarters.
Number 7, non-marketable equity securities. You are monitoring that $22.251 billion balance sheet item for any extreme gains, losses, or liquidity signals that might artificially inflate or depress the net income without reflecting the core business performance.
Number 8, Goodwill and intangibles. We noted $20.832 billion in goodwill and $3.306 billion in intangibles.
Any impairment charge applied to these lines would be a glaring warning sign that past acquisitions were overvalued and are underperforming.
Number 9, buybacks.
You are checking to see if management's repurchases remain sensible at the prevailing high valuation. If they continue plowing tens of billions of dollars into repurchasing stock at 44.9 times earnings, you have to seriously question the long-term capital allocation discipline.
And finally, number 10, export control and regulatory disclosures. Specifically, you must read the footnotes for anything tied to China data center compute revenue or new product-specific restrictions that could suddenly cut off high-margin revenue streams.
If we pull back from all these metrics, the conservative takeaway is simple, and it actively avoids the market hype. The latest financial reports show extraordinary business performance. The economics are historic, but extraordinary performance plus an extraordinary valuation does not equal a margin of safety.
The structural foundation is unshakable. The balance sheet is strong. Liquidity is strong, debt is modest, but the valuation itself is the primary load-bearing risk.
Exactly. At $220, the stock needs sustained high margins around 71% gross, strong data center demand near 90% of revenue, continued 80% cash conversion, and highly disciplined capital allocation.
A lot of things have to go right.
If all those assumptions hold perfectly, the market may very well keep rewarding the company.
But if any of those assumptions weaken, even slightly, the downside can come not only from lower actual earnings, but also from a severe multiple compression.
That is why the final verdict from a Graham Plus business quality lens is speculative, meaning it needs extreme caution. There is profound evidence of a great business, but weak evidence of a margin of safety.
The Formula One car again.
Think back to your Formula One analogy. The cars are brilliant, the engineering is flawless, but the price tag guarantees a catastrophic financial outcome if the team does anything less than win every single race, because there simply is no asset cushion beneath you.
Thanks for joining.
If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.
You can possess the most valuable asset on Earth, but if you rest it on a fragile foundation, the structure is in danger of collapse. In fiscal year 2026, NVIDIA scaled revenue to $215.9 billion, while maintaining a 71.1% GAAP gross margin, an economic profile with very few historical parallels at this volume. That top-line dominance translated into nearly $97 billion in actual realized free cash flow. The market responded to these operational metrics by pricing the stock at $220 per share, pushing the total market capitalization to $5.346 trillion. But analyzing a thriving business is an entirely different exercise from underwriting a defensible investment. In 1949, Benjamin Graham formalized the concept of the margin of safety, the strict requirement that an investor must pay significantly less for an asset than its mathematically calculated intrinsic value. To see if this $5.3 trillion valuation passes that test, we have to reverse engineer the math and find exactly what future realities investors are paying for today. We are looking for the specific, load-bearing assumptions holding this share price together. When a price eliminates downside protection, even a business with excellent economics becomes a high-risk speculation. Looking strictly at the corporate balance sheet, NVIDIA is a financial fortress. The company holds $62.5 billion in cash and marketable securities, stacked against a total debt load of just $8.4 billion. There is very little leverage risk here, with a net debt to EBITDA ratio of negative 0.41x. And that cash pile is constantly replenishing. The business converts revenue into free cash flow at 44.7% margin. Testing these metrics against Graham's classic frameworks, the liquidity and debt rows light up with passes. But reaching the valuation ratios, the structure fails. At $220, the market pays 44.9 times fiscal 2026 earnings and 34 times book value. Strip away the intangible assets and goodwill, and the multiple climbs to 40.1 times tangible book value. Physical assets provide zero downside cushion for the investor at this price point. Graham developed a specific formula, now called the Graham number, to find a stock's defensive intrinsic floor by blending earnings and book value. Run NVIDIA's fiscal 2026 data through that formula, and the maximum justifiable price is exactly $26.71. That reveals an 87.9% deficit between the mathematical floor of the business and the $220 trading price. Traditional asset protection is completely absent here. The entire valuation is untethered from the balance sheet and relies completely on the assumption of permanent, uninterrupted future growth. If traditional metrics fail, we must calculate exactly what future reality the $220 price demands. This chart compares NVIDIA's current fiscal 2026 reality against the requirements of its $5.3 trillion market cap. We start with the baseline earnings per share. In fiscal 2026, NVIDIA generated an EPS of $4.90. To bring the valuation down to a conservative, Graham-approved 15 times multiple at the current share price, earnings per share must reach $14.67. This requires the company to triple its net income from an already record-breaking base. The gap widens looking at free cash flow. Targeting a 5% yield, we start from the current fiscal 2026 free cash flow of $96.5 billion. To hit that yield on a $5.3 trillion market cap, the bar must reach $267.3 billion. NVIDIA would need to add over $170 billion in new free cash flow, a 177% increase over its current output. Right now, the stock offers a 1.81% free cash flow yield. This yield demands flawless corporate execution just to maintain its current valuation relative to lower-risk assets. That math assumes zero margin compression, endless expansion of the addressable market, and zero competitive decay. Buying at $220 effectively capitalizes decades of unproven, hypothetical growth that has yet to occur. That hypothetical future relies heavily on a single physical environment. In fiscal 2026, nearly 90% of all NVIDIA revenue, $193.7 billion, came strictly from the data center segment. This concentration makes the company highly sensitive to capital expenditure cycles from a small group of major tech clients. Regulatory intervention is often the most immediate threat to peak cycle margins. In the first quarter of fiscal 2026, the U.S. government implemented new export license restrictions specifically targeting NVIDIA's H200 products. This blocked immediate shipments into the Chinese market, which translated into a direct financial impact on the income statement. The company absorbed a $4.5 billion charge, which reduced quarterly gross margins from over 71% to 60.5%. A quieter pressure is also building in the working capital accounts. While revenue grew 65%, total inventory surged 112% to $21.4 billion. This indicates that production is currently outpacing market absorption. The valuation requires uninterrupted perfection, yet the operational data already shows vulnerabilities to regulatory changes and inventory imbalances. NVIDIA in fiscal year 2026 is an undisputed cash-generating machine. However, an asset's quality as an investment is dictated strictly by the price paid to acquire it. Paying 40 times tangible book value for a sub-2% free cash flow yield leaves the investor with no mathematical protection against a downturn. When an investment lacks solid foundational support, the massive weight of extreme expectations will eventually fracture the entire structure. Benjamin Graham's framework classifies this valuation as a speculative allocation.